The following is an interview with Brian Samson. Brian is a serial entrepreneur who's taken 3 separate companies from 0 to 4 million plus in revenue and has successfully exited multiple businesses. What makes this conversation fascinating isn't Brian's successes, it's actually his failures. Most entrepreneurs only talk about the wins. Brian breaks down exactly why 2 different acquisition deals fell apart, including a $7 million NASDAQ offer that would have been completely worthless if he'd taken it. Brian also dives into his current strategy of buying and scaling boring businesses in Hawaii, where he's able to triple valuations in 3 months without getting his hands dirty. The key questions we focus on: why do most acquisition deals fall apart and how to spot red flags early? What's the real difference between building versus buying businesses? How do you prepare for market crashes that can kill your exit overnight? And when should you use nearshore talent versus hiring locally? Without further ado, let's dive into the interview. Enjoy.
Brian, welcome on the show. You've been involved in 3 exits, but I want to flip the script and focus on the exits that didn't work and where they fell apart and how they fell apart. So would you dive into that first exit that you thought was going to happen and just didn't work out?
Yeah, there were 2 stories I could dive into. The first one I'll talk about, a NASDAQ company tried to acquire me, and what happened, why it didn't go through. So in just to kind of back up, like how I got into this company and then what we did, where the acquirer came from.
Yeah.
So in you know 2018, 2019 timeframe, I started this company where I had already had some years in Latin America, and I'm like, oh my god, like this talent level is insane. And there's also not just engineers but recruiters. So perfect, fluent English, work for a fraction of the price, same time zone as the States. And then I had this big network of VC funded tech companies. So I kind of put those 2 together, and I was like the broker in the middle, where I would charge, just on an hourly rate, these recruiters in Latin America, and then VC funded tech companies that are trying to hire like 50 engineers at once, would need all these sources and recruiters. So, fast forward a year later is COVID, and these are all like kind of project engagements. So, there was like that month in March, you guys all remember, and like every time the phone rang, it was a client like canceling the project or pausing the project. I'm like, this is horrible. And I was kind of down to like a string, um, and it was this like kind of hard moment of, do I keep this business going or do I, just dissolve it because I got to do something different. I'm glad I kept it because about 8 months later, it was like the biggest yo-yo back and forth, right? So in like October of 2020, the phone started ringing just nonstop. Like, we need recruiters, because that was the big, quiet quitting era, and everyone was going crazy. So all these VC funded tech companies were hiring like hundreds of people, and and the hardest job to find was not an engineer, it was a recruiter. So I was like the perfect company in the perfect time in the perfect place, just super lucky. So then fast forward to summer of 2021, I get approached by a company on the NASDAQ. Um, Now that sounds really cool, but they had just kind of like barely made the NASDAQ. They brought in this professional CEO. It was like a tech platform type company, and they were acquiring a bunch of like recruiting SaaS tech companies. And my business was a nice add-on because I had like 60 VC funded tech companies as clients. Um, they were very East Coast. I had the West Coast, a lot of California companies, 50 plus recruiters on billing. So it was like a really nice add-on for them. So they approached me. And probably one of the better things that I did, I think most people, when they get approached by an acquirer, is they take it to an attorney first. And attorneys are there to protect your risk, but they rarely maximize your upside. So what I did instead is I was lucky. I knew a guy who was a former investment banker for Goldman Sachs, and he had just gone out on his own. So he was like an M&A advisor and had all this deep experience in negotiating upside, and like I had him be my, like almost immediately have him be my go-between with the acquirer. So it took a lot of pressure off me. He's doing the calls, and I learned a lot about like terms I never learned about, from seeing him negotiate. And we didn't even get attorneys involved until kind of later. We had this M&A advisor driving it. Um, so uh, negotiations going on like a month or two. Um, and I can share some real numbers too. I'm sure your audience would be interested. So the initial price that they offered was 3 million, and almost all of it was, I won't say their name, but I'll say the numbers. Almost all of it was stock. Um, and if you've never gone through that process before, and we all know how rare it is to get an exit, it gets really exciting, and you kind of like, you get so emotional. You kind of lose your sanity, Um, so I'm really glad that I had this M&A advisor to kind of be in the middle, so I wasn't saying stupid stuff and just letting my excitement get the best of me. And he actually was able to up the ante on that offer to 7 million, through like different structures, a little bit of an earnout, but the earnout would only be a year. I'd only have to stay there for a year, so it ended up looking like a really good deal. Um, but the kicker was, it was still like 98% stock. And as a fresh NASDAQ company, that's their biggest currency, is like throwing around this brand new equity, from their valuation, shares in the company. So I started to, ask a bunch of my mentors, colleagues, like, hey, what do you guys think about this deal? Like, 7 million is kind of no joke, And honestly, this is a company that a year ago, in the thick of COVID, I probably would have sold this thing for $100,000 if somebody wrote me a check for it. Right? It was like on its deathbed. So a flip of like 100K to 7 million is pretty cool. Um, but actually, the best advice I got was, if you had $7 million in cash, would you buy their stock? I was like, well, no, no, not at all. Like, I don't want that stock. The stock is unreliable, unpredictable. It's like fresh to NASDAQ. It's based on a series of wild assumptions. Um, Now, if Google was on the other end, like, sure, that's a pretty safe, powerful stock, but not this company. And once I thought about it that way, it kind of brought me back down to earth, because you're in this like up and down of eagerness and excitement and emotions running high. And you start to think about that 7 million like it's real cash, and like all the things I'm going to buy. And I had 2 kids, let me provide for my family, all that. Um, but you realize, what could also be the worst thing that could happen. So anyway, I tried to restructure the deal so it was much more cash heavy. The problem was they didn't have the cash. They were just throwing currency around like as their stock. So the deal fell apart. Um, we just could not, see eye to eye. They could only offer stock, and I didn't want their stock, no matter how big that number sounded. So I think like that lesson that I took away is um, your acquirer matters. And I think um, they actually acquired a bunch of other like small SaaS recruiting tech type companies. Um, and because they're now public, so you can read like their like all their filings, and you can see all the stuff online. It's all very public, like what they offered, the deal structure, how much of it was cash, how much of it was stock, the terms, the earnout, the liability, all that stuff. So I kind of read all that, and they were serious. It was that's all they could offer was stock. um but 7 million cash is a lot different from 7 million in stock. So the deal did not go through. um and fast forward another year, that stock is completely in the toilet because the market crashed, the market cratered. Fast forward even 2 years later, um, that stock is at risk of being kicked off the NASDAQ because it's trading so low. And then fast forward even just a few months later, company doesn't exist anymore. So that's a
Wow.
exit that fell apart, but thank God.
Wow. That sounds like quite the emotional roller coaster. I guess the follow up question I have to that is just what was it like? I guess having the 7 million, even though it was stock, kind of waved in front of your face, and having that emotional roller coaster of looking at that, having a change of heart about it through good advice from people around you, and then I guess pulling back and not having the deal go, and then going back to operating the company. Like, what was that like?
Yeah. Well, I say your ego can get the best of you sometimes, because I wanted to tell everyone, about this deal, especially those that I didn't have a good working exit with, right? Like, I told you so. Look at me, look at me with all my success. I think it's kind of natural. Since then I hopefully matured a little bit, but I think at the time, that's what was going through my head. Um, but operating the company, it wasn't like catastrophic for at least like the first 9 months after, because we were earning seven figures in profit, right, as a company. So I had a nice paycheck coming in every single month. I was doing quite well. So there wasn't really like a life changing thing for me. And only one other person on my team knew. It was kind of like my right hand person. Otherwise, no one knew about this because you don't want to like ruffle feathers or make anybody anxious or stressed out before like closing day, right? Um, but it also like my business got hit pretty hard too, right? When the stock market crashed and VC funding took a turn a year after that acquisition, yeah, I could see my business start to falter a little bit too. Um, and I'd be lying if I said I didn't constantly check to see what I interpreted as my company's valuation versus that acquires valuation because it's public. It was easy to see. Um, so my saving grace there was that my valuation was dropping slower than their valuation. So and that's a big if that was inverse and like they just kind of caught some tailwind and it was booming and I was dying, I would have felt endless regret, right? But I was kind of in this fortunate position of I was able to stack a lot of cash and my business was still outperforming theirs, and it wasn't as consequential.
Brian, I'm curious. Like, this is more of an operator-focused question, just away from M&A for a moment. It's when how would you now, like in a market downturn when the market crashes, like you mentioned during COVID, it was tough, it was rough, like the lights almost felt like they turned off overnight. How would you even prepare for something like that when, and obviously it's different company to company, but just general principles? How would you prepare for, like, say another COVID happened? What would you do differently this time?
Yeah. So there was something that I did that I would do again, and then something that I would really mitigate against in the future. If you guys remember, I mean, none of us were alive, but we probably read in our books of like the 1929 stock market crash, and unemployment was like 20% or something crazy. Um, but what FDR did was this thing like the Great Public Works Act, and a lot of our national parks and things like that were created, just to keep people working. So that was a good thing that I did, and I also benefited from it later. Was we had a lot of people that didn't have a project, um, and I was in my right not to pay anybody to do anything. Um, but I try to think of like all the things that were kind of on our list that we just never got around to doing because we were busy. Like white papers and different content and some website stuff and building customer lists and databases. So I created my own like teeny tiny version of the Great Public Works Act and paid people, to do all these different projects. And that kind of kept them engaged. And it was stuff we needed for the company anyway. So when the phone started to ring again, we were ready, and we had all these people kind of in our orbit. They didn't give up on the company. And I think they were grateful. The thing that I would mitigate against, because it's easy to fall in this trap, is when times are good. So let me add this and then I'll make sure I answer your question. But when times are good, it's easy to just throw money like it's like Venezuelan currency or something. You just kind of like doesn't mean anything, you just kind of throw it around. And like, oh, this costs this much. Like in a downturn, there's no way you're buying that. But when you've got stacks of cash, yeah, like we'll take a flyer on it. Oh, whatever, we'll sign this invoice. Yeah, we'll buy this tool. And like discipline goes out the window. And discipline also goes out the window with hiring. Because you start, remember the market is tight because things are going well. So the labor market is tight. That means market for your internal talent is tight. Um, so it's harder to find great people. Great people cost a lot of money. There's a lot of average people available. So it's easy to lose discipline when times are going really well and you just bring on a bunch of average people that suck up resources but don't really push the company forward. And this happens almost all the time, every time, with companies. Like times go well, you just lose discipline. So that's something that I really care about today. And wisdom is your best teacher, right? You go through these things and you learn. So I would be a lot more sensitive to being disciplined even when times are really, really good. Um, and then I think you just asked about like kind of how to operate when times like the rug gets pulled out beneath you. And what I'd say about that is survival matters, right? And that's what I learned during COVID. I had a bunch of competitors in 2019 that just threw in the towel in 2020. So when that market came back, not only was I positioned, but I had a lot fewer competitors to deal with. Sometimes you just got to survive. Like, and there's no shame in uh, cutting your subscription, having to lay off a few people. Sometimes you just have to survive. And I'll always be mindful of that, because if your companies can survive, then you have opportunities later.
You get a chance at that exit. I'd love to kind of go back to something you said earlier. You mentioned obviously when you were approached by an acquirer and they came to you with an offer, you were able to have an outside advisor who was an ex-investment banker, and I think the original valuation was 4 million or 3 million, and he was able to get it to 7. What are some what are some negotiation tips or tactics that you saw from him during that process that you learned and picked up on, although the exit didn't go through? But what are some things that kind of led to him being able to almost double the valuation?
I think the biggest word that like I knew, but I didn't understand it in the investment banking language, was synergies. So there was, I think the phrase was like accretive synergies or something, which basically meant that like, um, uh, not only would um, the profits even grow, uh, because like they could cut a few things from my side. Um, they also had this ability where their valuation would increase. So as a company that was mostly tech, um, they were basically buying something for $1 that they could immediately revalue it at $4, because like services company versus tech company, and then all the assumptions of a booming market is that it'd be a 7 times revenue flip for them. So basically, what the investment banker was able to like connect the dots that I couldn't is, um, hey guys, like you're buying this for $1 or 3 million, whatever, but that 3 million is immediately worth 12 million to you, right? Um, and it could potentially be worth 21 million to you just overnight, based on like reasonable assumptions. So you're going to pay for that, right? And without him, I would have said, I mean, 3 million is 3 million. Like that's kind of cool.
Mm.
That's super interesting. Yeah, well, I think you mentioned having another exit where it didn't go through. So can you walk me through kind of that second exit where you were approached, or just tell me the
Yeah,
story on that? And what are some things that
yeah,
you took from the first one to the second one, and what were the differences?
yeah. So the second one was a really unusual structure. So it was essentially private equity. It was a UK private equity company that only purchased recruiting companies. So this is my same recruiting company. They came sniffing around about a year after that first deal fell through. So we're still doing fine. The market hasn't totally cratered yet. Um, and what they would do is they would value your company, and then call this like your kind of like cliff value, right? And then each side would then contribute money toward a brand new joint venture that would then kind of like own all of it. So, for example, my company, I would put in like, you know, say 250K, they would put in 250K. Um, and but we would maybe say value my company at 2 million or something, right? Like just to kind of use some real numbers. So both sides then have skin in the game. Both sides have ownership in this brand new entity. What I'm bringing to the table is a real operating business, and a founder that kind of knows what he's doing, with real revenue, real clients, and what they're bringing to the table is what I'm missing, because I'm like a 0 to 1 guy, right? Like I can get something off the ground. I've taken 3 different companies from 0 to 4 million in revenue. Not an easy feat, and but I've yet to reach the magic number of 10 million, right? I've yet to hit that mark. So, and that's where they play. They kind of play in that like 10 million to 100 million world, and the founder of that private equity company had sold his own recruiting company for 100 million, a few years prior. He knew this world. He knew scaling. He had this big Rolodex of potential buyers, strategic buyers. And he also had these professional people that knew about scaling, and they'd kind of worked at a bigger level, at a bigger scale. So like they know the types of managers that I need. They had the fiscal discipline, the corporate governance, um, the financial reporting that I need, the customer concentration, like all the pillars that you look for. So if I just wanted to exit, you know, at a sub 10 million valuation, I probably didn't need them. But if I wanted like a big time exit, they would be the company to do that. So that was interesting to me. Like, they're right. I didn't have that knowledge. I didn't have that experience. So they would fill that gap. So those are all the reasons why I liked it. In the pre-show, we were talking about UCLA. I'm part of a, well, not at the moment anymore, but for about 7 years, I was part of something called the UCLA MBA Founders Forum. So these are people that graduated with an MBA from UCLA and are founders of their own business. So I happen to live in Hawaii, but I was in this group with a bunch of San Francisco tech guys, so about a dozen people. So super smart. Some of them had raised like a Series B round. Others were a little bit, earlier stage, but like all ambitious, super smart founders. So we could like bring our challenges or issues to this group, kind of um, get vulnerable, and they would give us their perspective, their advice. So it's like kind of having your own board of advisors. Like they want you to succeed, but they don't work at your company. Like, there's no politics involved or egos or anything. You're just getting good, straight advice. So I brought this deal to them, and then they started to help me kind of understand it. So I didn't go back to the M&A banker because that one didn't quite make sense, because this is more like a private equity. We're both bringing money to the table. And the thing that um, made this a bad deal. So I wasn't a novice when it came to the VC world. I had worked for a bunch of VC funded tech companies. I had invested, and I had also had a lot of clients in this world. So, 10 years doing this, and you see a lot of VCs, like how they operate. And, like Andreessen Horowitz invests in you, or Sequoia, they invest in you. And not only are you getting capital and advice, but you're getting this team of operating partners, like a talent partner, a CFO partner, a legal partner, all this kind of added value to help support you. And it's free. It's just like part of their value add. In my particular deal, what they were doing is each of us invested money, and then part of that would go to pay my personal salary. So it's kind of like using my own money for my own salary. But then they would invest money, but I would be charged every month, almost like a franchise. Like think of like Dunkin' Donuts. If you own a Dunkin' Donuts franchise, before you collect a dollar, it's like 7% goes to corporate, like the franchise, owners, right? So I would basically be paying like 7%. And yeah, sure, they'd be giving me marketing and financial support. But I thought that was really backwards. Like, we're owners in this business. Why are you charging me, 6 figures a year for this type of service? And my UCLA board of advisors were like so infuriated by that model. They were like so pissed and angry that I would even be considering that. They're like, "What are you thinking? Why would you do that?" And it was unanimous. Like everyone was like, "Brian, you're idiotic for even entertaining this." And I trusted these guys, so it helped, again, like bring me back to normalcy and bring me back to life. And okay, like I kind of fell down that rabbit hole a little bit of, ooh, this is exciting, like, and I think this might be consistent with a lot of founders. We we struggle with conceptualizing the downside of anything. We tend to only see what could be. We tend to only look at things optimistically. And I still like this is, either like my best gift or my biggest weakness, right? Is like with every company, every deal, oh man, like this is going to be huge. Um, but I never look at, the potential downside. I probably need to hire somebody on my team to help me with that. Um, but I think most founders kind of fall into this. That's why we're founders. That's why we're entrepreneurs. You got to be optimistic. But they brought me back to life. They helped me see all the deal risks, all the issues, and this ridiculous fee structure. So when I went back to the PE firm and said, hey, like this fee structure is wrong. Nobody else does it this way. Why are you guys doing it this way? They held firm, and the deal fell apart because of that.
When you look back on both those deals, obviously they were unique, but what would you tell another founder or just someone who owns a business looking to exit to be prepared for? And also like get prepared for in advance because, at the end of the day, someone doesn't buy your business, you sell it. You have to be prepared for that to even happen and have the company structured correctly for it to happen. What would you say are some things now when you look back, and obviously you've been involved in exits, so that are crucial to get right and be prepared for before even a potential buyer comes across your table?
Yeah, I think there's three things. The first is you should always operate the business with the assumption that you're not going to sell it. Because the second you take your eyes off the ball, it gets really distracting going through a deal process, like really distracting. So when you take your eye off the ball, um, your business is bound to suffer. It's just bound to. You'll lose clients, projects don't go the way it should be, whatever. You'll just kind of lose out on that stuff. So uh, operate it like you're not going to sell it. The second thing I'll say is, although it's like kind of fun at the very, very beginning when you're going through incorporation and stuff to, oh man, I got to get all this stuff right. There's always opportunity to change it. I think that sometimes the opposite happens and brand new companies spend way too much time on trying to figure out the right legal structure when they don't even have a customer, right? Um, they're tinkering on their website. They're, you know, researching for weeks, like, oh, should I do a S corp or C corp, and what state? Who cares? You need You don't have a business if you don't have a customer. You don't have a revenue. So that'd be my advice there. And then I think the third thing is, which is easy to do, and it compounds, is create a data room. So I always do this on day one of my companies. You can do Google Drive or Monday or Asana or wherever, Dropbox. Every offer letter, client contract, vendor contract, tax return, anything goes right in that data room. You just file it. It's just like a muscle. So my biggest company today is called Plug Technologies. And we started the data room, on day one in 2022. And I mean, there's thousands of files in there now, but it's like very easy to give access to anybody that was interested. We're not selling it today, but when that were to happen, it's very easy for somebody to review it.
I'd love to kind of change pace. So today, I think you've bought a few home services companies and you've been, obviously a long history of taking companies from 0 to 1. You've had multiple exits on the sell side. What are some things you learned from actually being like a bootstrap founder, building businesses from zero, that you are able to kind of like some lessons you're able to apply to like actually being on the buy side and approaching founders to buy their company?
Yeah. Maybe I'll even talk about a buy that also fell through for me, but it gave me some lessons on buying. Um, so in last summer, so summer of 2024, I had a accepted LOI to purchase. And I'm sure a lot of your audience probably is in like the Cody Sanchez, boring business world, and I got drawn into that too. So summer of 2024, um, I stumbled upon this business that I thought was like reasonably undervalued. Again, I live in Oahu, Hawaii, and there was a business that was something I would never have imagined I would be interested in if I wasn't a financial buyer. It was a wedding linen company. So if you're getting married in Hawaii, maybe you'll do it at a hotel like the Four Seasons or something. Um, and then they use outside vendors, which, as the bride and groom, like you select. And there's only a few on island. This one was like the premium version, and like tablecloths, chairs, things like that. Um, so the list price versus the SDE, seller's discretionary earnings, it was a really good ratio. So I accepted my LOI, started to go through due diligence. I had my interest in it was learning about this SBA world. So like, oh, I could like not put a lot of money down. That's kind of cool. Keep my cash in my other businesses. I had a nice portfolio, a personal portfolio of real estate and stocks and stuff. So, man, I don't have to touch any of this stuff. I could just use the SBA. So I went through that process. SBA rates were like 10%. Not nothing. But I could still get in there with pretty low money down. And then as I started to do due diligence, um, there were like three things that I think I recognized. The first is if I'm going to fully outright buy a business, especially one that's under $1 million, which this one was. This was a husband and wife that owned it, and they had a couple like supervisors. But like once they're gone, a lot of institutional knowledge is out the door, right? And then I've got to find like a GM, or I've got to, go in there every Tuesday or something, So I've got to come up to speed on something, or I've got to hire the right person and quickly understand all the gaps in this business. And no matter how much due diligence you do, there's going to be gaps, right? There's going to be knowledge gaps. I think the second thing I was nervous about with the SBA was, I'm in my 40s now. I've acquired a lot of assets, and the SBA will go after all the assets it needs to protect itself. Where ironically, if I were like 25 years old and I didn't really have a whole lot, like the SBA doesn't have a lot of recourse against me. Sure, like the business could fail, but like maybe I take a credit hit for a little bit. Like I'll survive. But to have liens against multiple rental properties or whatever else, it's like I barely know this business. Like, do I really want to take a risk and have all these potential liens and risk on something that I've kind of spent like 6 weeks trying to get to know? And then the third thing was you're on the hook for 10 years. So again, like you're spending a summer getting to know a business that you're basically committing to for 10 years, because these SBA loan terms are 10 years. And sure, you could get shorter terms and stuff, but usually you want to lengthen it out. So I'd be spending like several $100,000 of interest and be on the hook for a decade for this business that I barely know. So I withdrew from that one, um, but I still had this like boring business bug. So I ended up buying two businesses in the last 6 months. Um, but when I say buying, my model's a little bit different. What I'm doing is buying existing home services companies here in Oahu, so I can meet the founder for coffee whenever I want. Um, in almost all cases that I've seen with boring businesses here, because Hawaii is a pretty expensive place, as good as they are, they're kind of hand to mouth. These are like guy in a truck businesses. They're not multi-million dollar companies. So they're kind of hand to mouth. So if they were to get a contract with a hotel or a property management company that was for net 30 or net 60 payment terms, they couldn't do that deal. And they also are missing a lot of basic stuff. Like they don't have a website. They don't have an ability to take credit card payments. Um, they don't have Yelp. They don't have an organized payroll. Maybe they haven't even filed taxes. Like all these things. So I had a guy who's like a CFA, CFO type person, um, and I told him about my model, and he's like, "Yeah, you're kind of like micro PE." So like I'm professionalizing this business. So I basically put money in um, to that new company. We always start a brand new LLC, so there's no liability that exists. They bring their customers, their know-how, their reputation, and we've got some working capital now, so we can take that property management net 30 deal. Uh, B, we can also professionalize the business website, organize payroll, pay taxes, all these things. So very quickly, we're now in like the top 5% of home services companies. That's happened right away, for these two businesses. And then you just look at like the valuation of the company at the time I put money in versus what it would be now if we were to say put this on biz buy sell and just use like very reasonable conservative multiples. I've essentially tripled my money in both cases. Um, and I also get like a nice monthly dividend. And my work is mostly done in like the first 3 months. It's like professionalizing it, but I'm not even getting my hands dirty. Like I'm not cleaning houses or, you know, mowing yards or anything like that. I'm the money guy, the infrastructure guy, and my partner in those businesses, um, there's a partner for each company because they have that special domain skill. They love it because they're getting capital, they're professionalizing their business, and they also can see the light that now they own an asset that could be sellable later, and they never had that before. So there are exit opportunities for them down the road, and now they have an asset that could fund their retirement that they never had before. So I'm hoping to do two of these deals every year. And I took all those lessons, from my past deals of like, how do I mitigate risk, but also how do I make this founder friendly? In a lot of cases, I think acquirers don't pitch that properly. Like, what's in it for me? What's in it for you? Um, so I try to lead with that, that I'm a credible person and I can help you um, get something you don't have, and probably can't do by yourself.
It's a really interesting model. I'd love a question that I have, like just personally, is being a 0 to 1 guy and then now transitioning and you've done these two deals and you mentioned you were able to add a bunch of value to the business within 3 months, basically triple your money, also get paid out from that. You're not doing any dirty work. Looking back on, like I think you mentioned earlier, like if you were 25 with less assets to your name, what model do you prefer, and like what model would you recommend people? Because there's obviously, as you mentioned, there's this Cody Sanchez of the world, and there's a lot of hype around buying boring businesses. But as someone who's done both, like I would just love to hear you elaborate on your perspective on it.
Yeah. So to clarify, so when I say triple my money, I've tripled my valuation in a private company, so I'm not liquidating that.
Right.
That's growing. So the monthly cash dividend is still, uh, on par with the size of that company, right? So it's not life changing. That's why you need lots of these things um, to live off of, cumulatively. Or at least where I'm at in my life, where I've got two kids in private school, and like expenses are much higher. So when you're 25, I think this would be a really great first deal to do. So if I were this, because I think my biggest regret probably in life is I waited too long to be an entrepreneur. Man, I should have just done this when I was like 22. Um, but I think doing like a very small deal where you're putting a little bit of money in, maybe a little bit more sweat equity, with a home services company could be really interesting because you kind of learn business on the fly. And then that second deal I would do would then be the SBA loan, um, because you don't have a lot of assets, you don't have a lot of risk, and you could still probably get into a business that at least could give you a living wage, for the foreseeable future. And then you just keep doubling down, take those profits, reinvest, reinvest, reinvest.
That's super interesting. I want to just jump into, as kind of the last topic, nearshoring, because that's something that your company focuses on, and I think it's like a good topic to talk about. Even though this podcast is more M&A focused, it's something that's interesting. And now with like the rise of AI and AI engineering, I think there's a lot of roles out there where like there's a lot of talent, especially in the Latin American market. How did you stumble across the concept of nearshoring? And as someone who's either a founder or someone who acquires companies and implements operators, etc., into those companies, well, what do you recommend is the use case and the benefit of nearshoring?
Yeah, in 2015, that was my very first entrepreneurship journey, where it was traditional, like raised a couple $1 million, had an investor. We were like a tech services company, built minimum viable products for San Francisco fintechs, and grew that to about 80 software developers. We put sales in San Francisco. I didn't have kids at the time, so my wife and I moved to Argentina and got my hands dirty, like finding the first office space, payroll, accountant, getting the entity set up, um, like right in the thick of it. And there's like the surface level benefits that I think, if you've never nearshored, this is the same time zone, right? It's talent that is overlapping fully with the U.S. There's no offshore. There's no midnight calls. There's no weird language barrier, or like they're speaking English but not English you're used to. So you got all these inherent benefits, right? Um, but then there's like the second level benefits, which are my favorite, is Latin America, for better or worse, has volatility, right? There's sometimes high inflation, some geopolitical volatility, and what that's created. And Latin America is not one country. There's a lot of them, and each one has different nuances. But what that's created is this population that's very driven, very hungry, and also very used to volatility. So if you're used to volatility, you're calm in chaos. You can overcome adversity. You have grit, scrappiness, flexibility, and you're really good at finding solutions to problems. Tell me an entrepreneur that wouldn't want somebody like that on their team, right? So that's the real secret to nearshoring. So same time zone, of course, and then English and the way that we're used to it in the States. So if you can get somebody like that on your team where the stakes are higher and you also don't have the kind of cash that like a Fortune 2000 company is going to have, and most of us don't, why not go for some talent that's just a little bit less expensive and shares the same workday as you, and then brings all those really interesting attributes to the table?
Yeah, it makes a lot of sense. Do you think, like, say it's a remote company, and people who are acquiring companies are listening to this? Do you think there's scenarios, or it's realistic to hire someone in a leadership team of those companies nearshoring? So even someone who's like the operator of a remote company. Do you think it's realistic to have someone who's nearshore, basically?
Yeah, I think this becomes more of a personal choice. Um, Now, Latin America has a big surge. I really think the 2020s is the decade for Latin America. There's a massive surge of founders, tech
Mm.
founders, VC money, early stage executives. And if you're hiring for that, you want people that have some of that experience already. So they're getting that experience now. Um, like as we maybe have seen in Singapore, Singapore has a ton of capital, but they kind of lack that startup experience. That's why it hasn't really taken off there. Latin America is getting both. They're getting capital and experience. So the talent is learning that. Now, my personal preference, and I think a lot of my clients' personal preference is there's like your core team that you probably want where you're at, but
Hmm.
then all the incremental roles I think can be hired. And that also means managers, so it's one thing to have like your executive team member. Maybe you want them right next to you in the office or in the city right next to it. Uh, but you're going to, as you scale, you're going to hire teams, you're going to hire managers. You can get both in Latin America.
Sin. That's awesome. I think that is a great way to wrap this episode. Brian, it's been amazing having you on. There's a lot we've covered. Is there anything else you would like to part with before we close the episode?
Uh, Really enjoyed the conversation, guys. You mind if I drop my company name here?
Please do.
Yeah,
Yeah, plug it. I think people will be
absolutely.
interested.
We'll put it in the description as well.
Okay, cool. Appreciate that. Yeah, so the nearshore company is Plug Technologies. That's PLUGG. And the website is plugg.tech, TECH. That's the best way to reach us and reach me.
And just to confirm as well, can you just tell, like, you have a backstory of that company and just overview so people are clear?
Yeah, Plug is your go-to company for nearshore talent. So, I think like our instinct today is like maybe I'll try Upwork or something. What we probably don't realize is Upwork kills contractors on fees.
Hmm.
So you might not pay it as the employer, but Upwork is just stealing money out of contractors' pockets. So really good talent does not want to go the Upwork route, and we don't touch anything from all of our fees are paid by the company. So we've got access to a huge network of great talent in Mexico, Argentina, Colombia, Peru, so on and so forth. We know the talent pockets. We know customs, how to get hardware in and out, labor pockets, English fluency. So we're both advisors and then talent brokers.
It's phenomenal. Okay, well, yeah, we'll drop it in the description, and it's been great covering M&A, initial hiring, and the exits and the acquisitions. And thank you for coming on, Brian.
Thanks,
Yeah.
Brian. That was a blast. Appreciate you sharing your wisdom.